Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
Andrew, you've got an incredible story. 3 years ago, you were just learning about rentals, and now you have a portfolio of over 100 doors. How did you do that so quickly?
Well, I used a lot of strategies, but it all started with a HELOC on my one-bedroom condo in Boston.
On the podcast today, we're going to talk about how Andrew took that equity that was just sitting in his condo, not making any return for him, and how he took that and used it to start buying rental properties that started to generate cash flow for him. We'll also talk about how he continued to build his rental portfolio once that money was gone. Joining us on the show today from Worcester, Massachusetts is Andrew Freed. We'll take a quick break to thank our sponsors. We'll come right back and we'll talk to Andrew. It's a lot of work to find a really good rental property. And when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender and her specialty is helping investors finance rental properties. She has a ton of loan programs and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com, NMLS 42056. Do you ever feel like you're using too many tools to manage your rentals, or maybe you're struggling to manage your rental finances? I wanted to introduce you to a platform to help you simplify your rental property finances. It's BaseLane. BaseLane is a rewarding banking platform where you can consolidate your rental finances while earning cash back and a high interest rate. BaseLane also doesn't charge any hidden fees like traditional banks do. BaseLane is also a rent collection platform where you can automate your rent collection so that you get paid on time every month and you're not wasting your time chasing down late payments. BaseLane is also a simple and easy to use accounting platform where you can categorize your transactions and monitor your cash flow. BaseLane is an all-in-one platform designed to help you manage your real estate business and save you time and money. The best part about it, it's totally free. You can learn more and sign up today. Just go to baselane.com. That's BASELANE.com. baselane.com.
Rental Income Podcast.
Andrew, I'm really excited to hear how you did this and how you did it so quickly. So before we get into your story, let's talk about your portfolio real quick. What does your portfolio look like today?
So my portfolio encompasses around 125 units across 20 to 25 properties, all ranging from 3 to 12 plexes.
Is there a certain bedroom and bathroom combination you like?
So what I will say is usually the smaller bedroom and bathrooms rent easier and the larger ones take longer to rent. But I have a plethora. It all comes down to the cost per unit versus the rent that I can get for that unit. So I have ones, twos, but to your point, primarily my own personal portfolio are kind of 3+ unit bedrooms.
Okay. All right. Well, let's go back to the very beginning. So you mentioned that this all started with a condo that you owned. Tell me about this property and how it helped you get started buying rentals.
So I really was just trying to not pay rent. And I just got a really good job. I just got my master's program. I quote unquote achieved the American dream. And at that point, I just kind of bought something within my means. And that was a small 1-bedroom condo in Dorchester, which is a part of Boston. And I bought that for around $222,000. And when I bought it, I really bought into the path of progress. Like technically, I really didn't want to live there, but I knew like Southie, which is the district over from Dorchester, was sprawling. There was a lot of economic growth over there. And I knew the path of progress was feeding over to Dorchester. And that's exactly why I bought it. So I more or less kind of didn't invest where I didn't live where I wanted to live. I invested where I thought I would want to live down the road. Okay. And that's exactly what I did. And in a matter of 7 years, the property doubled in value.
Wow. Incredible. Okay. So then you took that money and you used it to start buying rentals. So Did you sell the property or take out a line of credit against the property?
So I decided to take out a line of credit against the property. And at that point, I accumulated around $200,000 of equity. And I took all of that out back during COVID when I think lines of credit rates were like at 3%. So it was almost free money.
Yeah. All right. So you took that money and it sounds like you moved so that your first condo was in Boston. You're in Worcester now. That's about an hour away, right?
That's exactly correct. Yep.
Okay. So you took that money and you bought in Worcester. Was it just because it was cheaper or you could get better deals? Like, well, why not invest in Boston?
Those are all great questions. I mean, more or less, I was very much priced out of Boston, primarily due to the fact that there weren't a lot of multis that came on the market. And when they did, I would lose out on all cash offers. They were extremely competitive. Everybody wants to own in Boston. Mm-hmm. And at a certain point, after I lost 20, 30 offers, I just got frustrated. And I looked at the Massachusetts market. I'm like, all right, where is there a lot of multis? And it kind of pointed me to 2 or 3 cities. And then I asked myself, okay, where would I want to live out of these 3 cities? And Worcester was primarily the best choice. 30 to 40% of the housing stock in Worcester are multifamilies. So you throw a rock and you have almost a 50% chance of hitting a multifamily. It's way easier to find a deal when you target a market that has a plethora of that asset class. And that's exactly what I did. And that's when I got started. I did a house hack in Worcester, and that's where I own about 30 units today.
Now, did it feel like a big sacrifice that you're living in Boston, you've got your life there, to move an hour away to invest in real estate? Sounds like it could be a big sacrifice. Did it feel like that?
It absolutely felt like a sacrifice. I mean, I didn't have any friends out in Worcester. I didn't have any family out in Worcester. It was a huge kind of change for me, but I am incredibly thankful for that change, primarily because it really helped me control my environment and really helped me control who I surrounded myself with. I'm sure you hear this many times, but you're like the average of the 5 people you associate yourself with. So prior to that, a lot of my high school buddies, I mean, they had good jobs or whatever, but, they just did the typical American dream where, got a nice job, watch sports on the weekends, watch movies, essentially kind of procrastinated in their free time. And I really needed to surround myself around people really making it happen. And that's why it was kind of a blessing in disguise, because at that point, my friend group really kind of grew to all real estate investors. And it really helped me scale to have that deep network of people actually making it happen.
Yeah, I mean, that's really awesome. I don't know if we've had many people on the podcast that have actually moved to buy rentals. A lot of times people will buy rentals an hour away and keep living where they're living. But I think there's a big advantage to actually being there and becoming a local investor. So I got to hand it to you. So, all right, so you've got $200,000 from that condo HELOC. What did you end up buying?
So I ended up buying a 3-plex in Worcester for about $560,000 to use an FHA loan. So I only took about $40,000 from that line of credit to get into this triplex. And what the amazing thing about getting in this triplex is my mortgage on the building was around $3,200. It was a 3-unit property. Each unit rented for at that point it was $1,600. Now it's about $1,900. But more or less, 2 of the units covered my rent, my mortgage, right? So I was living in the 3rd unit. I was almost living for free. I mean, I was covering repair. I was covering CapEx, but still I was paying far lower than if I actually stayed in that condo in Boston, which was actually taking up about 50 to 60% of my monthly income in overhead. So it really exacerbated my ability to build wealth by reducing all of my expenses to relatively very close to zero.
Yeah, I mean, that's a huge difference. I mean, to have that kind of savings where you're no longer paying a mortgage payment, now you're living for free. I mean, that is like life-changing. Just having that extra cash flow. So, all right, so you used 40,000 of the 200 for that house hack. You've got 160,000. What did you do next?
So at that point, I had a couple different options become available. My mentor ended up putting together a 132 unit syndication about 45 minutes away from me. I thought it was a really good opportunity. Rents were like 40% where they should be, a ton of upside. So I actually took $65,000 from my line of credit and put it into this syndication as a limited partner. So more or less, I was paying 3% on the HELOC money, and I'm putting it into this asset class that provides a 15 to 20% annualized return, just utilizing the simple concept of arbitrage to build wealth. So at that point, I'm kind of using about 100K of my HELOC. And then I took about 80K more and bought the property right across the road from my neighbor, another triplex for about $450,000. And I brought 25% down. So I sold about 40K in stock and I used 80K for my line of credit. And at that point, I was up to about 6 units, well, 7 with my condo.
Okay, awesome. Now, a couple of big takeaways from what you've done. The first one is lowering your monthly overhead. I think that is huge and definitely, I think, gave you a big leg up and gave you more money to invest. And then the second is you built your portfolio so far by just moving equity around. Like this $200,000 was just sitting in that condo in Boston, and taking that equity and putting it to work kind of got you started.
Yeah. I mean, I realized early on in my investing career that my return on net worth was almost zero.
Yeah.
Like at that point, I think my net worth was around $250,000, most of which was locked up in my primary residence, that my 401k that was providing me zero dividends and zero yearly cash flow. And I really took a determined effort to really change that. So I transitioned a lot of that wealth into real estate as, an active investor as well as a passive investor.
Smart move. Okay, now the next thing you did to get some money to invest was you started earning more money. How did you earn more money?
So I essentially built a ton of bridges that were synergistic. So I started the largest real estate meetup in Worcester, Massachusetts, and simultaneously I became an investor-focused agent. So those two bridges really kind of work together in helping me build commissions in the form of helping other people get multifamily around Worcester. Additionally, I was self-managing all my properties, and that's income in itself. If I wasn't self-managing, I'd be hiring a property manager.
Yep.
So kind of those two things, along with working my W-2 and having my expenses really low, allowed me to save probably 80% of the money coming in.
Wow.
And on top of that, I mean, the tax benefits of real estate are amazing because every dollar I get to shelter that with depreciation. So I'm not paying any taxes on a dollar of income versus having my W-2. Every dollar I receive, I pay 35 cents in taxes.
Right.
So it's like it's actually more money when you get into real estate and you can shelter that with depreciation.
Right. All right. So just to make sure I'm clear, so you became a realtor and started selling houses, but you kept your W-2 job.
That's exactly correct. While simultaneously self-managing my properties. Yep.
Wow.
That's exactly what I did.
How many more properties were you able to buy using your real estate commissions?
So it was more or less every dollar I received went into buying real estate. So that could be after my first house hack, prior to leaving it, I opened up another line of credit on it to gain access to that equity as opposed to selling it. Every dollar I received from my agent business went to buying real estate. I spent nothing of that.
Wow.
Every additional dollar that I got from my W-2, I drive a Honda. I'm like, I got a roommate. Like I literally do what I can to live off like $2,000-$3,000 a month and put all that money into buying more real estate. So essentially every dollar I get, I just try to funnel it into more real estate, more or less the concept of compound interest. So
it's been 3 years since you got started and you're at 125 doors. Did you do anything else? Because that just seems like, although you're saving a lot of money, it seems like you got to a lot of doors in a very short period of time. Was it just from savings or was there anything else you were doing?
So it all comes down to return on net worth. Like, where is your money locked up? And what I did was I utilized equity in a lot of these properties to buy more properties, right? So when my first HELOC ran out, I opened up a second HELOC on my house hack, and it got around $75,000 more, right? So I used that to buy a triplex. A year later, that syndication sold for an 89% return. I funneled that money into another fiveplex that I split with somebody else. After that, I ended up opening up a business line of credit with the LLC I had for 2 years, $50,000 unsecured money. And I utilized that to buy more real estate. So I just figured out where I could borrow money at one rate and put that into a fund that provided a higher return.
Wow. Now, do you ever think that maybe you're too leveraged? And I know these properties have appreciated a lot, but I'm sure there's someone listening thinking, wow, like Andrew has a lot of debt. Do you ever think, or do you ever worry about being too leveraged?
So I make sure that every asset that I own is stabilized and self-sustaining before I move on to buying the next asset, right? Because the worst thing you could do in real estate is buy assets that cost you money every month, because your financial freedom number is going to get larger and larger and larger of how much money you need to survive on every month.
Right.
So that was number one, is just making sure assets are self-sustaining. The other big thing that I did was I always made sure to have an extremely strong cash position. And that might mean I have a line of credit drawn at $175,000 and have sitting on $100,000 in cash. Like, I'm cool with that, because there's one main reason why businesses go out of business, and that's because they run out of cash, right?
Yep.
So in my particular case, I don't care if I'm levered. As long as my leverage is providing cash flow that far exceeds that leverage and I have a strong cash position, I am super safe, in my opinion.
You have time to self-manage all these properties, or at this point, do you have either a manager or someone helping you?
So I have developed a team over time. When I first started, I did develop a bunch of systems, and I was doing everything. I was bookkeeping. I was coordinating contractors. I was communicating with the tenants. I was doing my social media. I was doing everything. But at a certain point, as I scaled, I slowly peeled off things that I did not like to do. And I slowly put people in that role to do that. So in this particular case, for self-managing, we hire like an 18-year-old kid that handles a lot of tenant communication, that leases our units, that meets the contractors, that meets appraisers on sites, that does smoke start walks for me. So I physically don't have to be there. Additionally, I have a team of 3 virtual assistants that help me with a lot of my administrative responsibilities, such as bookkeeping. I pay a VA in the Philippines $350 to do bookkeeping on per month on 11 LLCs. I have a social media VA that does all of my cuts up all my podcasts, does all my shorts, helps with captions. I have an executive assistant, virtual assistant that does skip tracing, does a data entry. Manages my CRM. So it's kind of things I've built up over time. But it didn't start that way. I was a one-man army for a good year and a half of my journey.
Wow. Now, what about finding deals? I mean, you bought a lot of properties in a very short period of time, in a period where prices are appreciating and it's been hard to find properties. How are you finding so many deals?
So I am finding deals by putting it out in the world that I know multifamily. I'm a subject matter expert. I'm here to help. So my last 4 deals were brought to me. All I did was put social media content out there, host a local real estate meetup, offer advice, expect nothing in return. And then when people found good deals and they couldn't take it down themselves, they thought, oh, who can take this down? Who would I like to work with? And my name came to mind, and they brought the deal to me. So I think, like I said, I think my last 4 or 5 deals were all brought to me.
That's so awesome. Now, tell me about the Meetup, because I think this is a great way to build your network, to build your team and to find other investors that will bring you deals. So you're running a local Meetup?
Yeah, so I'm running a local Meetup in Worcester, Massachusetts. I've been doing it for about 3 years. And yes, I totally agree with you. Having hosting a local meetup will make it so your network is really deep. It will connect you with really solid lenders, other investors, other contractors. It will essentially help you build your team. And to be honest, I've met all of my partners at these meetups. So they're incredibly powerful for scaling. And in my opinion, I very much think that meetups and networking are almost more important than education.
Yeah, absolutely. I mean, it's really, I think, cool to run the meetup because everybody knows you. If you're just attending the meetup, you're going to meet some people and make some connections. But when you're running the meetup, it's so much more powerful because everybody knows you.
Well, and it gives you a leg in the door on big players. Like if I go to a big player and ask them to be a guest at my 50-person meetup, they're going to jump at that, right?
Yeah.
But that also gives me the opportunity to get to know them, to learn from them, to leverage their expertise if a deal comes across my desk. And I've done that many, many times. Like I've had people be a guest speaker, and then that turned into either them providing me advice or somebody bringing me a deal because they know I'm the Worcester multifamily guy.
Right.
And it actually, and just to that point, it actually resulted in me getting one sixplex in Worcester that I literally walked into $200K in equity. It appraised $200K higher than what I bought it for because of these meetups.
It's so awesome. Yeah, I think it's a great idea. For anyone listening, you should really think about starting a local meetup. I think that's a great way to find deals and make connections. Now, let me ask you this. So now being in Massachusetts, it's not known as the most landlord-friendly state. Has that been a challenge at all to protect yourself from a tenant that's maybe going to be difficult to evict? Or is there anything that you're doing to make sure that you're protected?
So, when people zig, I zag, right? And what I like about Massachusetts is, yes, it's tenant friendly. However, that also reduces your competition. People around the nation don't want to buy in quote unquote Massachusetts because of the tenant laws, but it works in my favor. Then that means I have less competition in the area if I'm a good landlord, right?
Yeah.
And to be successful in Massachusetts, it's all about emotional intelligence, and it's all about creating win-wins for both you and the tenant. So what does that mean? That might mean like rather than, dealing with an eviction that takes 4 to 6 months, you might give them cash for keys, give them money to leave. And that might save you 2-3 months of vacancy, which will essentially be less cost than if you just waited out the entire eviction. Or, that also means like to not even get in an eviction in the first place by screening well, right? So those are kind of some of the tactics that I use to help me be successful in a tenant-friendly market.
That really goes to show you can make rentals work in any area. You've just got to have the right mindset and approach things the right way, and it sounds like that's what Andrew is doing. If anybody is in Worcester and you want to check out Andrew's meetup, or if you want to follow him on social media, I've got a link to everything on my website. You can find it at rentalincomepodcast.com/episode 447. I'd like to thank Chaley Ridge from Ridge Lending Group for sponsoring today's episode. If you've got equity in one or more of your properties and you want to figure out how to tap into that equity and grow your portfolio kind of like Andrew did, Chaley Ridge has a couple of different options on how you can tap into equity. She has a second position HELOC, and she also has HELOCs. You can borrow up to 70% of the value of your property. If you want to find out more, or you want to set up a time to talk to Chaley, you can track her down at ridgelendinggroup.com. That's RIDGE, lendinggroup.com, NMLS 42056. Thank you so much for checking out the podcast today. I really appreciate you listening and subscribing to the podcast. I'll be back with a new episode next Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.